This is an uncovered Japan company research report on Azbil Corporation, ticker 6845. Azbil supplies the systems that automate buildings, factories, and utilities. The central question is whether its installed base, nationwide service network, and disciplined cash returns can keep compounding while the shares trade near their historical valuation range. The starting snapshot is a quality and yield story rather than a deep value one. In the report, Azbil traded on a forward price-to-earnings ratio of 22.2 times, generated a 15.7% return on equity in fiscal 2025, and offered a 3.24% dividend yield. The balance sheet was funded by a 76.1% equity ratio. Uncovered Japan scores the opportunity 15 out of 20. High quality, but fairly priced for that quality. Before looking at valuation, it helps to make the product tangible. Azbil supplies sensors, controllers, software, and field service that keep office towers, factories, and utility networks operating efficiently. Building automation is the largest business, at 52% of sales, and reached an 18.5% operating margin in fiscal 2025. Advanced automation serves industrial process customers, while life automation includes meters and related infrastructure. The company is a focused automation specialist rather than a diversified electronics conglomerate. The segment mix explains the business. Building automation provides 52% of sales, and advanced automation another 37%, with both producing mid-teen or better margins. Life automation is smaller, at 11% of sales, and materially less profitable. The investment case depends mostly on the two strong segments: building systems supported by maintenance and retrofit work, and advanced automation built around differentiated industrial instruments and sensors. Over 5 years, revenue rose from 256.6 billion yen to 298.9 billion yen. Operating profit grew much faster, from 28.2 billion yen to a record 47.3 billion yen. That lifted the operating margin from 11% to 15.8%. Price pass-through, better mix, and cost discipline all contributed. It is a more attractive pattern than simple top-line growth, but it also makes future margin resilience a key item to monitor. Cash flow confirms the quality of the reported profits. Operating cash flow rose from 10.1 billion yen in fiscal 2021 to 38.0 billion yen in fiscal 2025, while free cash flow reached 31.5 billion yen. The report also identified roughly 100 billion yen of net cash. This gives Azbil unusual flexibility to invest, buy back shares, and pay dividends, while reducing the need to use leverage to support shareholder returns. Azbil's payout policy is flexible rather than formulaic, but the recent record has been unusually shareholder-friendly. The report notes 5 straight annual dividend increases, alongside sizable buybacks and proceeds from cross-shareholding reductions. Fiscal 2025 total payout exceeded 100% of net income. That is attractive for income-focused investors. Yet it also makes the durability of cash generation and the sustainability of the unusually high payout rate important to watch. The strongest part of the moat sits after the initial sale. Azbil's installed systems require maintenance, retrofit, and replacement over long cycles. Its nationwide network of roughly 4,000 engineers is difficult and expensive for a competitor to replicate. That service density supports customer relationships and turns each installation into a source of recurring work. The result is a moat based on operational continuity and switching costs, rather than on a single product feature. The medium-term plan targets 340 billion yen of revenue by fiscal 2027. Building energy efficiency, data center construction, and semiconductor-related sensors offer credible demand drivers. The report is also clear about the unresolved levers. Overseas revenue remains a modest share of sales, and life automation is lower margin. Those two businesses create upside if execution improves, but they are also where the plan is most exposed to disappointment. Relative valuation captures the trade-off. Azbil's 15.7% return on equity was the highest in the report's peer comparison, but its 22.2 times forward PE was broadly in line with its own 5-year average and not a clear discount. Investors are paying for business quality, cash generation, and returns. The key question is therefore not whether the company is cheap today, but whether the operating and strategic milestones can sustain that premium. The report's 3-year scenarios show a wide but instructive range, roughly 1,500 yen in the bear case, 2,200 yen in the base case, and 3,200 yen in the bull case, versus a report date price near 1,544 yen. These are the author's estimates, not price targets or recommendations. They frame the variables that matter most: margin retention, the 2027 plan, shareholder returns, and whether overseas and life automation improve. Azbil combines a hard-to-replicate service network, high-margin automation franchises, and a cash-rich balance sheet. The counterweight is valuation. The report found a quality business priced near its historical average, rather than an obvious bargain. The clearest indicators are operating margins, cash conversion, the durability of shareholder returns, and delivery in overseas and life automation. For the full 5-part research series, including the detailed valuation and risks, continue with the free deep dive at Uncovered Japan. For a much deeper look, visit the free deep dives at uncoveredjapan.com. We go beyond the headline numbers to cover the business, financials, valuation, risks, and catalysts. This video is for information and education only. It is not investment advice or a recommendation to buy or sell any security. Always do your own research.